Everything in share valuation comes down to earnings. Is the company making a profit? Is it doing exceptionally well? Is it having a poor time? Not only that, but how is it doing against its competitors? Should you be long of an outperforming stock and short of an underperforming stock? How can you work out which stocks are overperforming and underperforming? And how can you measure it? The classic measure that people look at is the price-earnings ratio. This is the measure between the price of the share and earnings per share. Earnings per share is the amount of money the company generates as profit divided by the number of shares in issue. If you take the earnings per share and compare it to the price of the share on the market, you get some idea of the price-earnings ratio. Another way of thinking about the price-earnings ratio is how many years' worth of earnings would you need to make off that share to reflect the share price. For example, if a share had a price-earnings ratio of 10, you'd need 10 years of earnings. In other words, you would need to hold the stock 10 years before you could recoup the price of actually owning the share. You can compare all the different stocks in the market against each other, which has a high price earnings and which has a low price earnings. The rule of thumb is that if a share has a low price earnings, it's at a relatively undervalued level. That's not always the case. It may be that the company is simply distributing large amounts of its income. Equally, if a share has a very high price earnings, the market is putting a relatively rich valuation on it, hoping that time earnings will increase, justifying the price. To get started and apply for an account, visit www.intertrader.com.